The trouble with these so-called revolutions is that people stop asking whether the promises can actually be delivered. They get swept up in excitement, assume the trend is permanent, and forget that every boom has limits. And when limits show up, they don't knock. They force their way in. This AI surge has been treated like a guaranteed pathway to endless growth. But markets don't hand out guarantees. When expectations climb faster than real progress, the gap eventually closes, and it never closes gently. You're starting to see the early signs of that adjustment now, even if most investors are pretending it isn't happening. If you'd like to stay out of harm's way, start paying attention to what the numbers aren't supporting. Hope can carry prices for a while, but it can't hold them up forever. When a story grows bigger than the results behind it, the ending is always the same, and it never favors the people who refuse to think clearly. The first fractures in any overhyped trend appear long before the crowd notices them. In the case of AI, the early signs are showing up in places where enthusiasm used to drown out doubt. When companies start promising more than they can deliver, and investors stop questioning the promises, that imbalance becomes the earliest crack in the foundation. You can see the strain when results stop matching the narrative. For months, people accepted projections that were little more than wishful thinking. Now the gap between what was promised and what's actually being achieved is widening. Anytime expectations outrun reality, the market eventually forces a painful correction. Another early fracture shows up in earnings reports. Firms that were once carried by hype alone are starting to reveal weaker than expected performance. Revenue growth slows, user metrics flatten, and adoption numbers become less impressive. These aren't catastrophic signals, but they are honest ones, and they cut through the fantasy. A subtle crack appears when companies begin shifting their language. They stop boasting about groundbreaking breakthroughs and start talking in vague terms like long-term potential and future alignment. When the story grows softer, it usually means the results can't support the noise anymore. The marketing tells its own story. Early in a hype cycle, companies don't need to inflate their messaging. The excitement sells itself. But now the campaigns are louder, flashier, and more desperate. When the selling becomes louder than the substance, it's a clear sign the enthusiasm is fading internally. Another early fracture is the slowdown in genuine innovation. Real breakthroughs are becoming rare, while superficial features get marketed as transformative achievements. When you see more rebranding than actual progress, you know the industry is stretching to maintain an illusion of momentum. One of the most telling signs comes from insiders. When executives start cashing out large portions of their stock while publicly preaching long-term confidence, you don't need a genius to figure out something is wrong. People with the most information are voting with their feet. Another crack forms when smaller firms begin collapsing quietly. Startups that were once celebrated as the next big thing are shutting down or being acquired for fractions of their previous valuations. These small failures don't make headlines, but they signal that funding is drying up and belief is weakening. You can also see the fractures in hiring patterns. Companies that once hired aggressively are now freezing recruitment or cutting staff. When an industry with supposedly unlimited potential starts shrinking its workforce, it means the underlying numbers aren't supporting the grand vision. A major fracture appears when investors lose patience. Early-stage investors who were once willing to wait years for profitability are now demanding tangible progress. When patience turns into pressure, weak companies crack under the weight of expectations they never should have taken on. Another warning sign is the shift in analyst tone. Analysts who once sounded like cheerleaders now sound uncertain, making cautious statements instead of bold predictions. When the loudest supporters begin softening their voices, it signals that doubt is finally reaching the surface. The fractures also show up when customers become frustrated. Companies overpromised what AI could do and underdelivered on reliability. When users stop being impressed and start pointing out limitations, the distance between hype and reality becomes impossible to hide. A subtle danger emerges when investors start comparing AI valuations to fundamentals. For a long time, those comparisons were ignored. Now people are looking more closely and the math no longer supports the narratives. Reality has a way of reappearing, even after long absences. Another fracture is reflected in rising competition. Too many companies are fighting for the same space using similar products. When differentiation disappears, the weaker players get exposed. Crowded markets collapse faster because there's no room for error. And the final early fracture, the one that signals the hype has exceeded its limit, is when confidence becomes fragile. Enthusiasm shifts to uncertainty, uncertainty to hesitation, and hesitation to withdrawal. Once confidence cracks, the entire structure built on it begins to unravel, revealing just how overstretched the hype truly was. The biggest danger in any booming industry is the set of assumptions people begin treating as facts. AI is no different. Investors convinced themselves the trend was unstoppable, and once assumptions harden into belief, people stop thinking carefully. The cracks you're seeing now aren't random. They're what happens when comfortable assumptions collide with reality. One major assumption was that demand for AI tools would grow endlessly. People forgot that businesses adopt new technologies slowly, not instantly. Companies are discovering that integrating AI is harder, slower, and more expensive than expected. That alone breaks a core belief that fueled the early excitement. Another assumption was that AI would solve every problem. Enthusiasts acted as though the technology could magically override limitations. In reality, many practical applications haven't lived up to the promises. When the results fall short, the entire narrative weakens and investors who relied on the myth start panicking. A popular assumption was that AI companies could scale revenue as fast as they scaled attention. But scaling a business is very different from scaling hype. Infrastructure costs, development expenses, and regulatory requirements have proven far heavier than most investors anticipated. There was also an assumption that competition wouldn't matter. Early movers believed they'd dominate forever, but now the field is crowded with dozens of companies offering nearly identical solutions. When differentiation disappears, the market's ability to justify enormous valuations disappears with it. Many investors assumed that consumers and businesses would accept AI instantly, but adoption is uneven, and skepticism is rising. People are learning that real-world reliability still has major limits. When expectations of mass adoption collide with slower reality, valuations must adjust. Another assumption was that AI productivity gains would immediately translate into profit, but businesses are realizing that the costs of training, operating, and maintaining AI systems can outweigh the short-term benefits. Profit takes time, something the hype cycle didn't allow for. People also assumed the regulatory environment would stay loose forever. That's no longer true. Governments are becoming more cautious, more demanding, and more willing to intervene. Regulation slows growth, raises costs, and introduces uncertainty, none of which was priced into the hype. A dangerous assumption was that data would always be free and easily accessible, but companies and countries are tightening control over their data. As access becomes restricted, training models becomes harder, slower, and far more expensive. The assumption of endless data is fading. Many assumed that talent would be unlimited, but AI requires highly specialized skill, and the talent pool is far smaller than the market believed. Scarcity slows progress, raises payroll costs, and prevents companies from scaling as quickly as investors imagined. A huge assumption was that AI could continuously improve at the same pace. The truth is that progress is slowing. Early leaps were easy because the baseline was low. Now each improvement requires exponentially more effort and resources. Growth curves flatten long before people expect them to. Another assumption was that hardware capacity could keep up with ambitions, but chip shortages, supply constraints, and rising costs reveal a physical bottleneck that limits the industry's speed. Technology can't outrun physical limitations forever. There was also a belief that customers would stay loyal, but AI customers switch tools quickly because switching costs are low. Loyalty disappears in a crowded market. When businesses switch frequently, revenue predictability collapses, and investors lose confidence. A subtle assumption was that bigger models are always better. Companies poured billions into size instead of efficiency. Now the industry is realizing that overbuilding creates diminishing returns and unsustainable expenses. That shift undermines an entire generation of strategies. Another critical assumption was that every AI company would eventually become profitable. Investors acted as though losses today guaranteed wealth tomorrow. But when the path to profitability is unclear or non-existent, the assumption stops being optimism and starts being delusion. And the final assumption, the one crumbling the fastest, is the belief that the AI cycle is immune to correction. People thought this was a new era that couldn't be questioned, but no industry, no matter how promising, escapes reality. When assumptions weaken, hype collapses, and once hype collapses, the market shows its true weight. The moment when optimism collides with reality always begins the same way. People stop nodding at the story and start asking a few uncomfortable questions. You can feel the shift when enthusiasm no longer carries the conversation. The assumptions that once sounded brilliant begin to sound a little fragile, and the tone of the market changes before anyone admits it. The turning point often appears quietly. It shows up when investors realize the impressive predictions they memorized don't match the actual results arriving quarter by quarter. That mismatch doesn't cause panic at first, but it plants a seed of doubt, and doubt, once planted, grows quickly in a market built on confidence. You see the shift in how people talk about the industry. Instead of confidently declaring the future, they start using cautious language, maybe if depending. That's a clear sign the story is losing power. When people add conditions to the narrative, it means they've started noticing the limits. Another sign of the turning point is when companies stretch harder to justify their valuations. Instead of presenting strong fundamentals, they highlight hypothetical possibilities. When a business leans too heavily on what might happen, it usually means the present isn't strong enough to speak for itself. The shift grows stronger when analysts stop cheering and start hedging their statements. Analysts don't change tone because they want to. They change because the numbers force them. And when the numbers weaken, the market's confidence weakens right along with them. Optimism truly cracks when investors start asking how much of the excitement is built on imagination instead of execution. The more they question the foundation, the more they see the gaps. Once the gaps become visible, the illusion of certainty disappears, and people begin preparing for the adjustment. You can also notice the turning point when insiders behave differently. They stop pushing grand visions and start managing expectations. When the people closest to the operation become cautious, it's not a coincidence. They're responding to realities outsiders are only beginning to sense. Another unmistakable sign appears when money becomes selective. Early in a hype cycle, capital flows into anything with a story. But when optimism fades, investors suddenly want proof instead of promises. That shift drains momentum from the weaker players and exposes who shouldn't have been funded in the first place. The turning point gains momentum when the public begins expressing disappointment. Expectations were unrealistic for so long that no real progress could satisfy them. When reality starts disappointing people who expected magic, confidence unravels faster than markets can stabilize. You also see the collision when companies miss targets they themselves set. Missed targets are not just operational issues. They signal the story isn't aligned with reality. When a vision overshoots its own roadmap, investors start wondering what else was exaggerated. The quiet but important moment comes when customers start talking about limitations more than achievements. Customers rarely complain loudly during a boom, but they always notice where something falls short. Their shift in tone reflects what's actually happening, not what investors hope is happening. A dramatic part of the turning point is when growth slows despite massive attention. When hype stops translating into acceleration, it reveals that the enthusiasm wasn't built on sustainable demand. Growth fueled by excitement can't last when the excitement fades. You'll also see companies adjusting guidance downward. That's the corporate equivalent of admitting reality is catching up. They mask it with careful language, but the meaning is clear. The future won't look as effortless as the past. Once guidance drops, belief drops right behind it. Another sign of collision is when the strongest firms begin distancing themselves from the weakest ones. Leaders want to avoid being associated with the hype-driven failures. That separation marks a shift from collective optimism to selective realism, and realism always wins eventually. And the final turning point arrives when people begin saying, maybe we got ahead of ourselves. That's the moment optimism has officially broken. Once the crowd admits it became too enthusiastic, the cycle enters its next phase, one defined not by story, but by scrutiny. Scrutiny is where reality takes over, and everything built on exaggeration begins to crumble. The rational path forward begins with stepping back from the noise. When markets slip into confusion, people start chasing every rumor and reacting to every fluctuation. That is how they drain their discipline. A calm thinker avoids that trap by returning to first principles. Understand what you own, why you own it, and whether it can survive without enthusiasm propping it up. The next step is resisting the urge to join the scramble. When crowds panic, they behave like a herd running toward cliffs. If you follow them, you'll share their outcome. Clear thinking requires ignoring the emotional stampede and evaluating opportunities based on durability, not excitement or fear. A stable path always prioritizes survival over heroics. You don't need to outsmart every cycle. You just need to avoid being one of the people destroyed by it. Keeping your decisions aligned with stability rather than thrill-seeking helps protect you from the chaos that wipes out the overconfident. One of the smartest moves is distinguishing between temporary turbulence and structural weakness. If something is merely noisy, it will stabilize, but if the foundation is flawed, no amount of optimism will fix it. Survival depends on understanding which is which, and most investors never learn to make that distinction. Rational behavior also requires controlling impulses. The greatest danger during uncertainty is acting because you feel pressured to do something. A good decision is rarely made under emotional strain. Patience, not speed, is what protects you when everyone else is rushing to adjust their positions. Another essential part of a rational path is looking at long-term value rather than short-term swings. Markets exaggerate both fear and excitement, but value reveals itself over time. If the fundamentals are solid, price volatility is just noise. If the fundamentals are weak, price stability is an illusion. A calm thinker maintains flexibility. Conditions change, and rigid strategies fail because they cannot adapt. Flexibility doesn't mean abandoning discipline. It means being ready to adjust your actions when the facts change, instead of clinging to outdated assumptions. The rational path also demands a strong respect for cash. Cash gives you control over timing. When others are forced to sell at terrible prices, cash allows you to act on your terms. Most investors learn this lesson only after losing opportunities they could have captured if they weren't overextended. Protecting yourself also means cutting exposure to things you don't fully understand. Complexity attracts people because it makes them feel sophisticated, but complexity often hides hidden risks that reveal themselves only when the environment tightens. Simplicity keeps you out of trouble when chaos hits. Another key is focusing on proven value creators. When hype fades, only businesses with real advantages and real cash flow survive. Choosing durability over glamour will save you from the painful resets that speculative assets face when confidence evaporates. A rational thinker never relies on the crowd for guidance. The crowd's behavior is almost always backward-looking. They become enthusiastic when risks are highest and terrified when opportunities appear. Moving in the opposite direction of the crowd has protected smart investors for generations. Part of the rational path is maintaining emotional distance. You can't think clearly when your decisions are tied to your ego. Markets don't reward pride, they punish it. Admitting uncertainty, acknowledging mistakes, and adjusting when necessary are signs of strength, not weakness. One of the safest habits is questioning your own assumptions constantly. The moment you become certain you're right is the moment you stop thinking. Certainty leads to oversized risks, and oversized risks lead to oversized losses. Humility keeps you from walking into traps others don't see. A rational strategy also recognizes that opportunities emerge when others panic. But those opportunities only belong to people who remain prepared. When the dust settles, the calm thinkers are the ones with the resources and clarity to act decisively while everyone else is repairing damage. And the final element of a rational path is appreciating that you don't need to predict the future. You only need to avoid the obvious mistakes. The people who survive every cycle aren't prophets, they're disciplined thinkers who avoid stupidity while the rest of the market rushes toward it. People forget that enthusiasm has a short lifespan, but consequences don't. What you're seeing now isn't the end of innovation, it's the end of pretending limits don't exist. If you keep your judgment anchored to facts instead of fantasies, you'll avoid the mistakes that trap everyone chasing excitement. The story may be changing, but clear thinking still works the same way it always has. Use it, and you won't have to fear whatever comes next.